Make the money. And there's Brant. Hi, Brant.
Hi, how are you doing?
Over the TV.
I just muted or silenced.
I couldn't get my guy Tyler to join in this time. He is one of our broker partners with NewFi. And he's been really, really good. Like, I will call him with questions for my investors. And like he's picking up his kids from school and you can hear him in their car seats in the back seat. I love it. But he always answers. What's this subtitle thing? Can you see that? No, you can't. Okay. Okay. My zooming. I did the TikTok hack.
What is that?
I didn't see that. So you, and I know I saw it somewhere, but hi, Brant. You pour heavy whipping cream over them before you bake them.
We've got to do that. No, I'm saying.
Got it.
The whole thing is like a middle. Yeah, it's like the whole thing's a middle section.
We have what's called a cinnamon roll draft at our house. You can figure out what that is. But yeah, we had first round pick of the soup. 24. Everybody fights over the first round pick. But with these, you really don't have like this. It's just a matter of which one has the most icing. I thought you did. A few more minutes. Guys, get settled in. I made cinnamon rolls. Apparently they're TikTok cinnamon rolls. Amazing. They're as close as you can get to cinnamon bun without going to cinnamon bun. So Cinnabon. All right, I think I'm good now. All right. Okay. Oh, look, it's my reminder for my training. Anybody have anything exciting going on this week? Interesting, exciting, annoying. Stop pointing to your wife. Oh my gosh. When I was in the bank, like I would get teased. Like I was like out here. And actually Nick and I both worked at the bank. And our financial advisor came up to me and he was like, you know who I feel sorry for? And I go, who? He goes, Nick. And I Nick, get out of my face. Oh, he knew how to push my buttons. All right, so I can get started. Ideally, I would like to leave a good like 20 minutes for any questions or if we want to go over any actual like spreadsheets, profit and loss statements. I will open with this disclaimer. Obviously, I am not a tax professional. I can tell you how we look at things on our side. I can tell you what I've done in my like personal finances. Obviously, you want to consult a professional on all of these, but I was just here to like put some opportunities like front of mind so that maybe you can pursue that with whoever you're working with on your financials. And then being able to apply it when you do go to finance. What happened there? Is there a short in this corner? Maybe I just need to stay away from the cord. And then just being able to apply what we have reported to the government into whether it's a primary residence for yourself, an investment residence for yourself, or being able to help the self-employed borrowers along. 'Cause I know a lot of self-employed borrowers don't know the first thing about what we're looking at, and they think if they take any deductions, like they're screwed. They don't know they have these options. So they automatically take themselves out of the market from the get-go. But we do have a lot of options. And where, like, in years past, some of the portfolioed or brokered loans that we're gonna talk about might have been like 3 and 4% higher on interest rates. We're not seeing that big of a spread now in this market. So the pros and cons definitely outweigh the cons more in this market that we're seeing. So what we actually look at when we're calculating, I'm going to jump one slide ahead, is this section of your tax return.
I'm gonna have you, no, you're good. I want you to
Disconnected.
share screen. Just so Brant and Danielle and Justin
That's
can be part of the
nice.
party.
That's nice of you.
Thank
That's
you.
so inclusive. So this is the section particularly that we're looking at. It's the 1040 form. It's one of the schedules, a lot of times Schedule C of your tax return. And we're looking particularly at the deduction section. So it all boils down to this. You're gonna have lots of different schedules and everything else. I think that's the HDMI that's still.
I think it might be. Have you done casting before?
No, on this one.
Sorry, guys.
Mark hit my cord, blame Mark.
Yeah, right.
It was working until you walked up.
You know what? Do you know,
Hell.
do you know, Kayla, where you normally do your casting from? Is it somewhere down here? Display link graphics? No.
Would it be at the Bluetooth? Would the Bluetooth pick up the TV? If I stay away from the cord, at least,
Well,
is it fine?
no. Yeah, we need to go into casting. Where's your settings?
Brightness display.
Bluetooth is on. Let's just turn it off and turn it back on. Give it some time to think about itself. HDMI should be working. Wondering if it's just a spot.
I think it was a short because it was when I like kicked it.
I'll sneak it around that way. I did something.
I'm wondering if this link.
Okay, that's your computer, but it's in display mode. We'll move it over. Oh, okay.
Oh, I like that more.
Share screen. For this, the PowerPoint. I'll do that again. Where's the cursor?
Is that what Zoom's seeing too?
Yes,
Okay, cool.
and we can see the Zoom folks here. So I can just keep an eye on that. But that should work.
All right. Back on track. It's okay. Thank you. I usually call on Ben to help me with those things when they trip up. Okay. So the 1040 form is what we're looking at when we are calculating the core of your income if we're doing this in a conventional manner. So we have self-employed borrowers who have W-2 themselves out of the business. We get to use both the W-2 income and whatever profit or loss they have on the business on that 1040 form. So if they have a $20,000 a year base salary that they reported for themselves, we use that out of the gate, but then we also go and do our calculations and add that business income as long as they're they have more than 25% ownership in the company. So that's really nice. A lot of people will, take the deduction for salaries, commissions, pay. Like you can get that deduction, but you're also paying yourself at the same time. Okay, so a lot of my borrowers my self-employed borrowers have done it, not many. Like I can tell you maybe 10% of the self-employed borrowers that I see are W-2ing themselves from the business. I don't know if there's a benefit or if maybe they're just not aware that they need this. And then we look at a 2-year average of those tax returns. Okay, so if we have, and that's why on a conventional product, government requires that we have a 2-year average so that we can have like a confident equation of what we can expect that business to do moving forward. Okay, so we need to have a good forecast of at least 3 years is what we want to see. And the only way to do that is to look back at least 2 years and average out those incomes. So if their first year they were dumping a ton of money, investing a ton of money into the business, if you were doing advertising or lead buying and things like that, we know that first year probably took a little bit of a loss. Second year was a lot stronger. Those investments paid off. Now we do a 2-year average. If the second year is actually declining, we have to average it off of just that second year. So we have to take the worst case scenario out of the 2 income years on your business tax returns. So that's what can be a little bit discouraging for self-employed borrowers. It's just the fact that the ebbs and flows of business don't always work out when you're in reality ready to buy, or your clients are ready to buy, or you have an investment opportunity. So again, this might get a little confusing because we're going to go from our conventional government conforming way of calculating, and then we're going to go off into a whole new world, which will be really fun. But the 3 sections that I want you to focus in on are the depreciation, the depletion, and the amortization schedule. So these 3 deductions are not tangible deductions. They're, imaginary money, if you will. They are not reoccurring. So those can actually be added back into your bottom line. We can justify that. We can add them back into your bottom line. So some areas of opportunity here are taking deductions in those lines, which means what? You buy a car, you do depreciation on the car. Now, you want to talk to your accountants on this because I believe you can only take deduction or mileage. You have to pick and choose. So how that benefits you at the end, whatever you're going to net, is up to you. But if you have the goal of buying and this is the route you want to go, that might be a good option. You can do upfront depreciation. So you can do your depreciation schedule with your accountant and just decide to lump it all into like 1 or 2 years instead of spreading it out over the schedule. So you can, depreciate up front, get that deduction from your tax return, and then file for your pre-approval on your mortgage, take that deduction, put it back into your income. So you get to have your cake and eat it too, if you will, is how I explain it to my clients. And then the best time to start the loan process, and this is why we've scheduled this class purposely for this time of year is when you are getting those tax returns ready. So you can have these conversations with your accountant. You can get everything printed and bring it over to your loan officer. They can actually tell you what your income calculation is before you file it. I always stress that you can go back up to 2 years on your tax returns and amend those taxes. Why? Because maybe you know exactly how you need to file in this 2023 tax year, but maybe you wanted to revise some of those things and boost your income that you're reporting for the previous year. Now you only have to go back 1 year to revise. You might have to pay a little bit more taxes on whatever you're claiming additionally. Maybe not. Maybe you move something over to depreciation. And then you only have to file one new form and now you're ready to go. You have the income that you've projected that you want for whatever your purchase is. Okay. So we kind of work backwards into that. And I'm happy to do that with you too. I also, let people know to give my information to their accountant too. If they're comfortable with that, the accountant can call me, ask me whatever questions they need, and we can get everybody on the same page. So this is probably like a double mega agent, but in this scenario, this was like a net of, I don't know how to get my cursor over there. This box moved. There we go. They had a gross, I think it was 10 million gross profit of $10 million at the beginning of the year. Their expenses were 5.36. Yeah, right. This is a double mega agent apparently. But when we're looking at the deductions left in 13, 14, this is not the right form. But the depreciation depletion areas are the ones that we would then take this section and add it back into their net. Okay, so when they're deducting 5 million, now they get another 78,000 for the year added back into the end to show you how that works.
We ever give you a tax form?
Yeah, I know. I blanked out your names. I didn't want anybody feeling insecure.
She deleted a couple zeros too.
Knocking down your doors, trying to get best practices. So that's how we look at self-employed borrowers for conventional. It's heavily regulated through the government. Now we're going to transition into this world of portfolio loans, brokered loans, and in this world, they're not government mandated. They can take on whatever risk they want, and they can set the parameters around it. So they charge a little bit extra for these products, so keep that in mind. It's not, like I said, it's going to be like 0.5% to 1.5% more. There we go. On your interest rate. But in these cases, it can be very beneficial for you. So a DSCR, this is a debt service ratio or debt service coverage ratio loan. What this does and this is not just for self-employed borrowers, this is for all borrowers. They can look at an investment property based on the return of the rent. So when we do order an appraisal, there's an extra schedule that the appraiser has to do for us that determines the fair market rent for that property. And as long as you have the 20 to 30% down, they will actually use the rental income for your repayment income on the loan. You don't have to submit any other documentation for your own income. They're going to look at the income that the property is going to bring in. They're going to look at the cash that you're bringing to the table. They do require 620 credit score. If there's been any bankruptcies, foreclosures, repossessions, they're going to require a 3-year seasoning on that. And then the other thing that I found interesting is this could be a first-time investor. It does not have to be a seasoned, experienced investor. So if the numbers make sense and they have the cash to put down, they can start their investment based on the rent schedule alone. Okay. It's literally that simple. So gross rent divided by the monthly payment of the new property, including the taxes and insurance. As long as that qualifies, they can sign on the dotted line. Okay.
Can they do that on vacant properties since they're going to have an appraisal for the rent. Okay, because I always figured that it had to be occupied already, and lease, that lease.
Yeah.
Okay.
So they do what's called an occupancy schedule, accounting for 75% occupancy, and then they leave a 25% buffer in there for vacancies. So it doesn't necessarily have to be rented out, which is why we have to pay for the special form that the appraiser is going to do all that added work for us. So yeah, I mean, nothing.
It's only for a first time, it's not.
No, it's not only for a first time. Typically for these portfolio programs, sometimes they want to have experienced investors, but for these programs, they don't have to have any investment experience. They can buy their first investment property with the DSCR loan, only counting the rental income, as long as they have the cash to put down.
And the 20%, how much is the cash down?
20 to 30%, depending, yeah, on the loan amount and the units. We can go up to 8 units. So there's one that's 1 to 4 units, and then there's another program that's 5 to 8 units. Yeah. And, oh, there we go. Yep, the 5 to 8 units. So this requires a little bit more. You need 35% down. You also need a 660 credit score. And they do, is this the one I saw? No, maybe that's the bank statement loan. The vacancy, they will allow for 2 vacancies on this one. So they are not doing the occupancy ratio here. They'll allow for 2 vacancies out of the 8 units, 5 to 8 units. So as long as those others, sometimes they will require 2 appraisals. It's up to the investor. So don't be surprised. It's not out of the norm. This one says that it only requires the 1 appraisal, but when an investor is taking the risk, they can reserve the right to order a second appraisal that you would have to pay for. But they just want to know that they have that rent calculation, like it's not skewed, like they have a fair market value, because obviously they're not in the area, they don't really know. It could be skewed based on one appraiser's opinion. And this loan amount goes up to $2 million. That is our DSDR. And again, this doesn't have to be self-employed. It doesn't require any income documentation. We're only looking at the appraisal schedule.
How do the rates tend to look? Is it 2 points more than a traditional product or more expensive?
Depending on credit, it could be like a 0.5 point more. I've seen it 3% higher. I did a loan, and again, this is for self-employed borrowers, but it was an asset depletion loan. So she lost her husband. They had a retirement account that she hadn't tapped into yet. And she was a waitress and she wanted to buy like a $300,000 house. So in that case, she was 3% higher. And we had other debts that put her debt to income ratio up higher. So there's a lot that goes into it. Trenton just had we'll transition to the bank statement loan. Trenton just had one, and he said it was literally only 70.75% higher than what the market was on that.
I have a question. In regards to the credit score, is it going to be based off the individual buying it? But let's just say we have an LLC that we purchasing it. Is it going to be based off of the credit history of the LLC, or is it going to be based off of our own individual credit scores?
So the credit scores would be person. It would have to be the individual. We can put it into the LLC at closing, but you would have to base the whole loan on your person. Mm-hmm. All right. So this is probably one of my favorite portfolio loans. A lot of people don't believe me when I tell them that we can do bank statement loans. This is going to base their income off of either 12 months or 24 months of bank statements. So whatever you think would make you look better, that's what we go with. If you want to only bring me 12, we can do that. If you want to bring me 24, we can also see between the two, after we've done our calculations, which one gives you more income. We need to get rid of 12 months, we can, okay? So in this calculation, they're going to take all of the business deposit. So it is much easier when we have separate business funds from your personal, but we can take personal bank statements to calculate the business deposit, okay? So they're gonna comb through each of those statements, identify all of the business deposits, calculate, sum those up. They will divide them by the 12 months or the 24 months, whatever we're using. If it's a service industry like ours, we're gonna do a 40% expense ratio, which means we'll use 60% of those deposits, and that's your end, averaged over 12 months. If it is a goods related, it's a 60% ratio, which means we're only using 40% of their deposits. A lot of times, especially for the service, I had a landscaper. We went from, like $1,200 a month in income to like $25,000 a month in income because of the business deposits. So this could be a big game changer. Especially when you're looking at, it's nice because we don't have like all of these little checks coming in if we're collecting on services in the real estate industry. You have these big commission checks. They're super simple to drop in this calculation. And we can go from there as far as like what's the best route? Do we use the 12%? Do we use the 24%? Do I get a better rate on the bank statement loan than I do on my DSCR loan? So we can look at all the options with you. So the bank statement loan for this particular investor that we work with, they go up to $3 million. They do require a minimum of $150,000. This is for a purchase price. Yeah. Again, this one is a little bit more lenient. So DSCR needed 3 years removed from any bankruptcies, foreclosures, repossessions. This one will go for 2 years. So that's another good option if somebody has, some stuff in their past. This one does require 2 years of self-employment. The next loan that we'll look at, it only requires 1 1099. Okay. So, this will go for owner occupied second homes. If it says non-owner occupied, that also refers to our investment properties. The owner of the business can own a little less than 50%. So you do have to have 50% ownership in your company. Most of the ones that I've seen, they're all owners, but I did have a couple of restaurants that had 50% ownership, and we did just fine with it. We did. It was still more beneficial than going the conventional route. Oh, I keep doing it. Okay, so the last one that we're going to talk. Yep.
At the end of the 12-month period, the bank account could have $0, but you're looking at the deposits, calculating 60% of that, say $200,000 of deposits came in.
Mm-hmm.
Even if the account balance is $0 today, we can calculate 60% of that.
Yeah.
That person.
They're not looking at any of the expenses on the bank statement side. That's what the ratio equates for or accounts for. They're only looking at the deposits. Mm-hmm. Yeah. They're not looking at average month balance or anything like that.
Not to go too deep or nerdy on this, but
I love the nerdy question.
Read my questions, guys. How much due diligence is done on the nature of those deposits? If someone sees that, there was an $80,000 deposit, they normally have $3,000
Yeah.
deposit. It's well, money came in and we can verify that it came in.
I honestly I haven't had anything pop up where they were scrutinizing one particular deposit over the other. I can see that could, especially if they did something like they took out a business loan and deposited a business loan into it. Obviously, I think they're going to look at any of the other debts or liabilities. So there is another profit and loss statement. So anybody doing the bank statement loans, they have to fill out a profit and loss schedule as well as a budgeting analysis form. So they'll disclose those things, and I'm assuming that would pick up any new debt that was open that might show up as a deposit or an asset within those bank statements. But that's a good question because we actually don't. Yeah. But we actually don't decision these files in-house. So we do have to send them to the broker for decisioning. They're the ones that analyze and underwrite the file. But we're your point person for all of them. Mm-hmm. Okay. So we have our 1099. Mark just bought you some time. This is great. You're not gonna miss the last product. So the 1099, just what do you think, if you have a 1099 coming from, a contractor, you can use that income instead of looking at what you've deducted out of that 1099 on your tax return. We just look at the 1099. They take 75% of your 1099, so that accounts for the 25% of expenses, deductions that you would have taken, and that's what they use for your annual income. We do not need 2 years on this. We only need your most recent 1 year 1099. Okay. So this particular one also offers bank statement loans, asset depletion loans, the 1099 loans. So these advantages all fall under all of those programs. But again, you're going to be at a minimum of 30% down on these types of loans, only because it's higher risk, only requires a 620 credit score, which is what we require typically on a FHA loan conventionally. We can go as low as 550 on our end, but they're going to have just like a little bit higher bar. They do have a DTI ratio of 50%, which is still very generous. Again, that's pretty much the highest we're going to go out of conventional anyways. And usually when you're using that 75% of the 1099, that's enough income. You're not going to have to worry about your ratio as long as your expenses. And two, if there's anything on, I can't believe I forgot to mention this. If you have any liabilities on your credit report that the business is paid out for 12 months, you can show that this car payment came from the business account for the last 12 months. We get to exclude that from your personal credit report because we know that it's going to be deducted on your income and we don't need to ding you for it 2 different places, right? So if that's the case, always let me know. I mean, I try to look for those opportunities, but sometimes like people just forget to mention, hey, by the way, I know this, and this is under my personal credit, but the business actually pays for that. You don't get dinged twice. Okay. So that was the SDR loan. So that was basically it. I wanted to leave plenty of time for questions because when you put loans in this conventional box and like you have all the regulations, especially for self-employed borrowers, and they're getting penalized for all these deductions, it's very hard to wrap your head around, like, how can we do this? Like, how is this possible? The biggest constraint I would say, like, you can say the sky's the limit on these income programs. The biggest constraint is with the larger down payments, people will just run out of the cash quicker. Like they want to keep rolling money over into new investment properties, but it's the cash that runs out first. So that's the frustration with a lot of investors. They do a lot more, but it does require more down because it's higher risk.
30%.
Yeah, 20. Yeah, some of them can be 25%. Most of them are 30%. In some cases, they do. I saw one come back. They needed to have 50% down.
How long does the money have to be in the account before they ask where that came from? I'm not trying to do anything shady, I'm just asking.
Mike and I are the shady ones.
I think like closing funds have 1 month seasoning. Like we're actually using the funds on the transaction. It's 1 month seasoning. But if we're calculating it as a deposit for income on a bank statement loan, there's no seasoning. Yeah, so that's what he was kind of asking, like, are they going to look into each deposit? Like if your typical deposit is 3,000 and you have one deposit for 30,000, are they going to look into that? I don't know for sure how they analyze this, but when you apply for those loans, they have you do a business analysis form and profit and loss form. So say you've taken out a business 30,000 and they deposit that to your checking account, it's going to show up on this business. So I would think that wouldn't, like, you wouldn't be able to use that as actual income, but that's something I can probably get a clear answer on and then send out with the slideshow.
So one thing I'm thinking about is, what if we use, like a HELOC from our own personal, so we didn't have to go to a bank and we took out like 30 grand, and they're just sitting there. So that way we're not having to go deal with the bank.
Yeah.
Necessarily
even if so it's a HELOC, it's your own equity, you don't even have to let that. If you left because that's the thing, once you pull it off, you're paying now interest on each month, but it's an interest only payment, but it's a variable rate. You can leave that there and just pull it when you're ready for it, because all we have to do is account for the monthly payment. So we say, okay, this is their asset, we're gonna move it into the checking account, now we're gonna add the $300 a month payment on their liabilities, because that's what the interest is on it, and we move on, no fee. Else have any questions? Is there anybody on the Zoom? Everybody glaze over. Look at the chat. Anybody on our Zoom have any questions? There's nothing now. Anybody else think of anything?
So the last one, they're gonna check just your 1099, anything else, nothing?
No, your last year's 1099. Yeah. Because they're gonna take 25% away from it, like that's just expenses. But yeah, they can, and again, it's not government mandated, so they can set these parameters in place, but they're taking on the risk and they have other, guidelines that you have to follow. But no, they're not gonna look at the tax return that you file with the 1099. They'll collect your bank statements because they need to verify funds for closing. But they'll go back 6 months or 60 days on the bank statement. Yeah.
So where the DSCR loans, like you said, a couple points higher than the standard, is that higher than mortgage rates or is that higher than prime rates?
That's our mortgage. Yeah.
Nice try.
What?
But it's pretty on par, because like if you look at the mortgage rates on a primary residence and then you turn that same conventional into an investment, your interest rate's going to go up anyways. So it's going to be very comparable to conventional loan when you're just looking at it as investments.
And it's a fixed rate, it's not variable.
No variable rates, unless we're doing like a buyback. Yeah, question. Well, thank you all for coming out. And I know the tax is following right after this class. So I think I want to sit in on that one. But there's still cinnamon rolls, I think, if anybody wants to.
Fun to pair these two topics.
Uh-huh.
Some investor, and you guys are thinking about that, and maybe thinking about that, and the tax savings conversation relative to the loan eligibility conversation. You have to be really smart. Of course, taxes, and that means you can hardly show any income.
Yeah.
That makes it difficult to fall back.
I had that problem for some years.
Yeah.
I mean, like, I wanted to buy more, but we cannot because we've been
Tapped out.
It's gonna be better for us to do something like that.
Yeah.
I have invested property.
Yeah.
Before it was different. Now it's a little bit more tight.
Right. It's more regulated. Yeah.
So wherever you go, they say, oh, no.
Yeah. Conventional, yeah.
So obviously we can buy it, be the agent for ourselves, and can we apply the commission from the buyer side towards our down payment on it? Okay.
Yeah. I've had like grandparents that were realtors gift their commission to their buyer grandchild at closing.
It's been nice.
Yeah. Yeah. I thought that was really cool. But yeah, I was like, good deal with that. Yeah, that's a great question.
How we can apply?
Come see me. Come see me. So I did open it up on my Facebook video, but if you want to make an appointment with me so that I know I can block off a certain amount of time, because I can look over your conventional side of things, but everything else I send out because the investor themselves wants to calculate all the, they don't let us do any calculation. So they have their spreadsheets, their formats. All we have to do is collect, the bank statements, the 1099, whatever that is. You don't have to have anything filed. We'll just send it off. They can tell us what income we're using. I can give you an estimated rate on that at the time, and then you can kind of decide which route you want to take before you ever even file. So it's nice. It's nice to have a game plan, because like I said, a lot of people don't know about these products at all. So you don't want to shoot yourself in the foot by filing too quickly. and not knowing the numbers first. How those work out.
So you just need the 1099, you don't need like the file.
If you want to do 1099 further, no.
So that, oh, like I said, one program is 1099. The second program was the
Bank statement.
bank statement, okay?
And then DSDR is the one that uses rental income. Yep, that debt service coverage ratio.
I just about that one last year maybe, but you know, they didn't know anything about it. I heard that one, internet, but
Yeah, I know it's starting to be a big buzzword on the street, and I feel like the rates have gotten a little bit better. I think that people are looking for more creative ways and they're able to kind of hedge their risk, so they're pushing it out a lot more.
you know, each one is, I mean, the best for you, like we said, those kind of basic situation.
Yeah, it is. It's gonna depend on like what's the rental on the investment property you're looking at. Like maybe DSCR would be better, or maybe you can get a better rate on the 1099 loan, or the bank statement loan. So you've got a lot of options. So I have no problem looking into all of them, so you can weigh them.
Okay, I had a client, so we try with the bank statement. He has a lot of bank statement, but so he has a bankruptcy 4 years ago.
Oh,
They dropped him down and they said they cannot do it.
so
So
we
he had
have
a lot of money, maybe just example, 120,000,
yeah.
but they said we can pre-approve him on 110, 120,000 because of the bankruptcy.
Yeah.
And
Yeah.
how many years is it?
Typically it's 3. But it's up to the investor because they're the one taking the risk. Yeah, so I guess if they want to change that parameter because of the risk on the file, they can do it, but we can take a look at it too, because we need 3, I believe it was 3 on the bank statement loan. One of them was 2. Seasoning, 2 years actually on the bank statement loan.
Okay,
Mm-hmm.
we can do that. A year of the bank statement,
Yeah.
so.
Yeah.
It would be nice.
Mm-hmm. Yeah, and if 12 months is better to look at than 24 months, then
12 months is good, like I said, but he just, you know, like in May is gonna be 5 years.
Yeah, I mean, and we look at the discharge date, so that could have been like filing date, discharge date can be different. But yeah, I mean, 5 years should be plenty of time.
Yeah. But he applied also for credit card, they didn't give it to him.
Well, that's conventional. Yeah. All right. Well, thank you guys all for coming. Thank you for your time. Hope you got something out of it.
So for the DSC